So, welcome to our April 2026 podcast, where we go beyond the headlines to explore what is really on the mind of investors. Welcome, my partner, Dan Lesneski.
Good to be here.
And Dan, I think this month it's fair to say that most investors will probably be happy to put the first quarter of 2026 behind us a bit, right? I'll start off by walking through some of the numbers as usual, and then we'll introduce our great guest speaker that we have today. So a little bit of a warning, some of the numbers are not pretty this particular month, right? I would say last month was tough, even after a strong rally on that final day. And we might forget that just a couple of days ago on March 31st, that last day of the quarter was actually pretty good. It was actually the best day of the year so far. But even with that, that was a day that saw the S&P was up about 3%, the NASDAQ was up 4%, and the Dow was up over 1,100 points. But that wasn't enough to offset, which was overall the worst quarter in about 4 years. And I had to double check that. According to the Wall Street Journal, it was the worst quarter since the second quarter of 2022. We all want to put 2022 in.
A lot of parallels between 2022 and now as well, though, with geopolitical events. So
true, and we want to put that out of our memory as well. So for the quarter, just as far as the numbers, the S&P declined about 4.6%. The NASDAQ was down about 7.1%, and the Dow was down about 3.6%. But importantly, we saw kind of a meaningful shift in tone, and actually at one point, a bit of a correction, a meaningful correction from peak to trough. In fact, a couple days before the end of the quarter, the NASDAQ did briefly officially enter in that market correction territory, which is about a 10% sell-off. And I think the Dow, Catherine or Dan, hit that for a brief couple seconds as well. So it was officially a correction. And the market breadth was not great in March, for example. 10 of the 11 sectors were down during the month. So it's pretty interesting how quickly sentiment has changed a bit. I was looking at our December podcast, Dan. Things were pretty rosy back then. The narrative was definitely different. Growth was accelerating. The Fed was looking to be in a position to cut interest rates. And there was a bit of an optimism that we talked about where we saw a market rally that was broadening out a bit beyond the AI stocks like NVIDIA and the big tech. And that was a good sign. But, so in a matter of weeks, things changed a bunch. We all know geopolitical tensions took center stage there. We had the conflict in the Middle East. We've had oil spike up as of this morning, something like 65% higher than it was at that time. So it's a bit of a change. So a lot has changed. For one, expectations on the rate cut by the Fed that's pretty much evaporated. We're just looking at some numbers this morning. Funny, just a month ago on the podcast, we discussed that there was an 80% probability of 2 cuts for this year. And now this morning, it looks like there's about 5%, less than a 5% odds of even one cut. So that's quite a change. I don't know if you're seeing the same thing, but it's some things are doing okay, right? Because we've had, for one thing, earnings expectations continue to increase. Valuations maybe are a bit better than they were. In fact, tech multiples have come down meaningfully. So that's so it's interesting that we're also seeing more individual stocks outperforming the index than I've seen in years. So that's something that we have to look forward to. And while the quarter was challenging, it's also creating, kind of a different investment landscape than we had just a few months ago. So that's a good thing.
More of a stock picker's market.
And that's why we have a stock picker with us. And to help us think through it all, both from a market perspective and, from a long-term investment standpoint, we're really excited to have Catherine Avery on our podcast. So Catherine, we'll give you a brief introduction. Catherine has over 40 years of experience in the financial markets, and she's someone who has truly seen it all, right? And successfully navigated so many different market cycles. She began her career at a time when the industry looked a lot different than it does today, starting in Oppenheimer funds while still in college. We like to hear that story when we're in Austin, Catherine, how you did that. And she quickly rose through the ranks to become a portfolio manager in the early days at EF Hutton Asset Management. And I'll tell a funny story. We were teasing Dan before the podcast. Dan's a 30-something. And we said, Dan, what was the commercial with E.F. Hutton back in the day. And I wonder if Joe, our producer, would know that. He probably wouldn't because he's around the same age. And Dan's guess was, you said?
My guess was we manage money the old-fashioned way, which was Smith Barney, unfortunately. But
And Catherine and I both have roots there as well, and E.F. Hutton. But E.F. Hutton, if you remember, clients was when E.F. Hutton talks, people listen. So that was a great commentary. I had started in the business in 1994, and the office was an E.F. Hutton office. And then when I started, it changed. It was Shearson Lehman Hutton. Catherine will remember all these names. Then I think Shearson Lehman Hutton became Shearson Lehman Brothers, became Smith Barney Shearson, became Smith Barney Morgan Stanley. So some people sat in that building and had, I don't know, 8, 9 different name changes. So I thought that was interesting. So after that, after E.F. Hutton, back to Catherine, she worked at firms like Prudential Securities and then Morgan Stanley, managing institutional portfolios and leading investment teams. But what Dan and I think what really stands out about Catherine is not that she succeeded in all those big firms, and she did, but she went out to build her own firm, which was exciting. In 2007, Catherine founded Catherine Avery Investment Management. Since then, she's built a firm with a very strong track record, particularly in the dividend-focused portfolio strategies. And she's been widely recognized across the industry, including, Catherine, congratulations, a couple different managers of the decade. That's pretty hard to get multiple manager of the decade honors. So congratulations there. And she's been a frequent voice in financial media, including Bloomberg, CNBC, and Barron's. So Catherine, it's great to have you with us. And I know my partner Dan here has a series of questions for you. First one I had for you, though, is going through some of those negative numbers for the first quarter. Dan was showing me your portfolio this morning. You're up, looks like over 5% on a year-to-date basis. So congratulations. First question would be, how were you able to navigate through that first quarter?
Well, you know what? Well, thanks for having me, first of all.
Thanks for joining us.
We really kept the portfolios diversified and pretty well spread out through most of the 10, S&P 500 sectors. We didn't have any, what I would call major overweights in the portfolio, but we did recognize that there was value for investors, not only from the dividend side, but from the earnings side in several key sectors. And that was energy, utilities, and healthcare. And each one of those sectors also carries a pretty hefty dividend yield along with it. So, we still kept our, we had lowered our weightings in technology towards the end of last year. So we went from we were probably about 19% at one point, went down to about 15%. We'll get to that, but we still see opportunities in that area. But I think keeping that focus on, companies with lower valuations, quality dividends, quality managements, quality balance sheets was really helpful in getting through this really tons of volatility. I mean, because what we saw do well in January and February was not necessarily how the quarter ended. So
that is true. Dan, questions?
Yeah, and just I guess as we look ahead into the second quarter, and we're going to get right back into a fresh earnings season, talk a little bit more about that in terms of where you see the opportunities moving forward, maybe from a sector basis.
Yeah, I think we like the way we have our playbook at the moment. What we're talking a lot about is, the K-shaped portfolio. In the first beginning of this year, we talked a lot about the K-shaped economy. Now it's all about the K-shaped portfolio, and having that mixture in the portfolio. Now we're primarily value-based anyway, but within that value, looking for things that, are more defensive and more offensive at the same time, because we really don't know how this is all going to go. I mean, energy prices are up. They're going to stay elevated for a long time. If we get oil back to $75, I think that's probably going to be the floor this year. So, we're going to have that elevated inflation. So you want to stick to the lower valuation sectors. The lower valuation sectors are those the healthcare, financials, the utilities, and the energy sector still. So, and again, we'll sprinkle that with, with keeping our weighting at about 15% in technology. Technology is getting very interesting in here. The PEs have come down dramatically in that sector. Dividend yields are starting to go up. Earnings are good. And in about a week and a half or so, we're going to start with the financial companies reporting. So far, we don't see any of people, coming out and saying, look, we're not going to make the quarter. Last quarter, profits margins were up about 14%. We expect that to continue to still be good. Unfortunately, what's good for corporate profits is not always good for consumers. We are seeing a lot of layoffs. The employment number came out this morning. The jobs number was a huge surprise. We had about 133,000 jobs added to non-farm payrolls, but we did see another hefty revision to the February numbers. So, there's a lot going on there underneath the surface that you really have to look at. And the unemployment situation, the way we see it, is that if you look at those people who want to be in the workforce but are not included is actually much higher and adds to the unemployment report, making it look like it's more like 5.5%. So good news on the corporate profit side. They're laying off people. It's becoming more profitable for them. They're using a lot more AI. Consumer seems to be weakening a little bit more. So those are a couple of the things that we're looking at.
It's interesting with that report as well that, they gave a headline reduction in the unemployment rate, but even if you peel that back a little bit too, it's because they downwardly revised the pool of job seekers by almost 400,000, right, which accounted for that drop. So it's, I'm not sure. You hear a lot about it on the financial news that the job market is maybe not as strong as it appears, and then obviously the anecdotal evidence talking to recent college grads or folks in the tech sector. It's been a very challenging market. So I wonder when that really starts to kind of play itself out in the investment landscape. It seems like we've had a relatively muted reaction to kind of a continuing stream of challenging headlines.
Well, again, getting back to that K-shaped theory, with the K-shaped economy, we have, a lot of the baby boomers who have saved money for all these years and have been beneficiaries of, the growth in the financial markets. They're still spending. They're going on trips. They're traveling. They're going out to restaurants. We haven't really seen a downturn in that as of yet. But it's that middle to lower income and these recent college grads who are really suffering out there. So what looks a little squirrely underneath the surface could actually translate into somewhat decent to sideways moving numbers. So, that's why we have to kind of, pick our spots and where do we go, to place our assets to invest. Like in the unemployment report this morning, they said that most of the jobs that were created were in healthcare. Okay, well, not surprising, given that, the baby boomers are now anywhere from 80 to 60 years old. And as they age, they're going to need more healthcare. So that's another reason why we like that sector. It's going to continue to give us stable earnings growth, stable dividends, rising dividends. So we kind of look for spots like that. And again, in the energy sector, as I said before, we don't think that oil stocks are going back down to, $50 or $60 a share, a barrel. We're going to stay probably at that $75 level. And we still really, really don't know how much energy we're going to need to power all these AI systems that we have. There is a possibility we can get caught short in an energy squeeze. So as long as those companies are cash flow positive, returning cash back to shareholders, and are delivering on earnings, I think that's a place where you're going to want to put your money.
Wow. When you mentioned the sectors, just digging down a little bit deeper, I don't know if I've seen a quarter like this where I'll call it like a bar approach. Sorry, easy or not that easy to say, but I'm looking at energy up 33%, materials up 11%, and on the other flip side, you have financials down 9.3%, technology down 8% for the quarter. That's pretty extreme. I don't see any sector that's like near flat. Have you seen that before? Does that, yeah, I would think that creates a difficult market for investors to try and trade through.
It is very difficult, and that's why we're constantly watching, where we are with the valuations on the companies that we own, and making sure that, when we see a company that reaches our price target, that we move out. Now, during the first quarter, we had sold, we have an overweight in energy, right? So we started the year with about 12% in energy. We're now down to 9%. We sold our position in Baker Hughes. The stock had reached our price target, but we found an opportunity to move into Omnicom, which had, a better dividend yield, and, still had a lot more room to grow on its valuation. So, we're looking for, opportunities like that all the time. We sold our position in Raytheon, a little bit, well, actually we timed that actually pretty well, the Raytheon, but, that stock was trading at 31 times forward earnings. Even though, we were in a, geopolitical crisis here, how much further could that really go on a short-term basis? And we were able to trade into a company like Eversource, which is a Connecticut utility company. So trading down in valuation, trading up in yield. So we're constantly looking for these opportunities all the time. You don't want to stay with companies that are overvalued in this market, because the volatility can definitely whipsaw you. So
It's just I'm thinking more about the volatile markets we're in right now, and there's a lot of parallels between what's going on today versus what was occurring in 2022, and I'm just curious from your standpoint, in terms of maybe stock selection or sector selection, how true those parallels are, and what are maybe some of the key differences between, say the start of the Ukraine conflict and then obviously, the start of the conflict in the Middle East.
right. Well, 2022 was really characterized by rising interest rates. So when we finally got into, January of 2022, we made a conscious decision to take anything in the portfolio that had a valuation above the S&P 500 to either trade it into something else or dramatically cut back on that position if it was overweighted. And that's what helped us through 2020, because in 2022 we were up 0.5% while the market was down, and we did focus on higher dividend yielding companies during that period of time. So that combination, everyone forgets, the value of a dividend yield, but when markets are down and volatile, the dividend is the only source of a positive return for that company. So for those investors who are relying on their portfolio for income, or they want an easier ride to get through the volatility, that dividend really matters. So our portfolio right now is at about a 3.3% dividend yield. So it's hefty enough that if we do have a correction like we saw in March, that it's going to give you some support on the overall portfolio. And again, for those people who use that as a source of income, at least that there's a higher probability that income is going to continue to be in that portfolio for you to live off of.
A lot of clients will be watching this podcast have through the decades had, things like we've talked about dividend ruler portfolios or, dividend growth portfolios, not necessarily maximizing dividends. So could you expand on your philosophy and maybe use this as an opportunity? Because I think we probably should have given you this opportunity up front to talk a little bit about your philosophy, what you do when you manage money, a little bit about your firm, and then how do you think about that dividend growth trade versus just a high dividend paying portfolio.
Yeah. So like yourself, Brett and Dan, I came out of a large wirehouse firm as well. And at Morgan Stanley, which was originally Dean Witter Intercapital for me, uh, we, we had a flagship portfolio called the Dividend Growth Fund. And that was the team I worked on. I actually managed dividend growth, separately managed accounts. And I managed an equity income fund, which was focused on higher yielding dividend paying stocks. And what I had found that over the years is that when you just focus on dividend growth, right? Now you can have a company, for example, like Visa, which has a dividend yield of below 1%. And all they have to do is increase it by about 2 cents, and you have like a 50% dividend increase.
Right.
So that sounds great, right, on
Yeah.
the dividend increase, but it's not going to do much for you if the market's down and you're looking for some yield support. And never mind if the market's volatile, but even just trying to get some level of income to support yourself throughout the year, it's not going to really do much for you. So what I had found over the years managing these two portfolios side by side, that if you don't go to the high tier of dividend yield, but you come down to almost like that second tier, where you focus between those that are around 4% at the high end and maybe around 2% at the bottom end, and you get this portfolio at around 3.3%, you're able to maximize the dividend growth, maximize the dividend yield, and also maximize the capital appreciation at the same time in the overall portfolio. Because when you really think about it, what do our investors out there really need? They need the income to live off of. They're not going to really get that from bonds. And they need to have the capital appreciation to stay ahead of inflation so they don't run out of money. So that's what we're really trying to do for everyone out there, is to create that portfolio that fits that narrative for them.
Do you set a floor on your portfolio? I think last time I spoke with you, I had mentioned Microsoft. It seems enticing. They pay a small dividend, but is that not enough for you to buy something that's down, tremendously from its high because it's below a certain floor?
Well, our screening process starts at the S&P dividend yield or higher. But every once in a while, we may make an exception and say, you know what, we're kind of right there. And as long as we're going to get the dividend growth, we may be able to put that in the portfolio, because there are some really good bargains out there in the tech sector now. Oracle is even one of them. Oracle is now trading at an above the S&P dividend yield. Earnings going forward, 25% growth. So, there's still a lot in the tech sector that has room to grow, in our opinion. We just have to keep a really careful eye on where the cap spending is going and whether or not how far they're reducing their cash flows.
It's interesting. I was thinking back to 2022 as well, and you're spot on with the interest rate environment being very different in that way. But I also recall some pretty sizable dividend aristocrats during that period of time, kind of losing that status and either remaining flat or opting for cuts. Given the market environment we're in right now, and looking at that the universe that you're covering, you know, are there any kind of warning signs flashing for some of the let's call it long-term stable dividend payers, just with the particular cocktail of what's going on in the markets right now?
Yeah. One of the things that we keep an eye on are the cash flows of companies. And, myself and, Jeff Cianci, who is our director of research, do a lot of work on where that cash flow is coming from and how much of that translates into free cash flow per share. So it's really, really important that you have a company that has a free cash flow yield that's at least equal to, if not greater than, the dividend yield. So that's when you really know that you have enough coverage to not only pay that dividend and the flexibility if something goes wrong with the profits of a company, but also that ability to increase that dividend as well. So that's usually a big flag for us. When we start to see that free cash flow yield go below the dividend yield, we get a little worried. Usually, these companies are often big enough that we get some pretty decent warning on that.
One thing you mentioned tech. Yeah, I'm looking at current numbers. I think this morning. So tech's down like 23 forward earnings PE ratio from like 29. So that's attractive. And I saw a stat that said 58% of stocks have outperformed the index through the quarter, or through the first quarter, in which they said, I think the Wall Street Journal said, is the highest since 2021. And then before that, it was 2010. Do you expect that to continue?
We do. I think that's as we spoke about before, it's a healthy sign for the market to see that broadening out, not just focused on one sector. But again, this is definitely going to be a stock picker's market. And, you really have to do your homework. It's not like you could just say, well, I'm just going to buy that sector and we're done with it. You really want to make sure that you're buying that quality, you're buying that yield, and you're buying that growth at the same time.
Okay. Well, we have to make a segue. It's a funny thing. We built this podcast. The premise was trying to just talk about, and Dan and I meet before the podcast to talk about what's on the mind of investors. And every month we field questions from clients, and it's all around AI. So I can't believe, I don't know how far we're into the podcast. We haven't,
30 minutes
I don't think
in.
anybody mentioned AI. So, shame on us, unless you did, Catherine. So how do you think about AI in your world of dividends? You would think, maybe AI would not be in the dividend world, but how do you play AI going forward?
Well, at this point, originally it was all about the tech sector, right?
Right.
So we basically had looked for companies that came onto our screens that had attractive dividends and would take advantage of the AI ecosystem. So for us, it's not just about, the big players. It's also about the players surrounding that whole ecosystem, like the Ciscos of the world, Hewlett Packard Enterprises, the boring big companies that, were put out to pasture for a while, but are now, they're all needed to grow the infrastructure out for the AI. And then you go into, as I said before, we have an overweight in utilities. Boring utility companies are now needed to power data centers. The whole data center is a big focus on getting the AI to work for everyone. So, surrounding yourself in these other areas that are outside beneficiaries of just a direct trade into these companies is how we're looking to position the portfolio. And when you really think about it too, financials, consumer discretionary companies, every company out there is almost going to be a beneficiary of AI. And we're starting to see that translate into the earnings of these companies. Last quarter, as I said, the profit margins had grown by about 14%, a lot of it attributable to AI, and that's going to continue. So AI is no longer just limited to technology. It's pretty much infiltrated into the whole corporate world.
Got it. Any follow-ups there? Dan is our AI director. Our firm, you have to have an AI director at your firm.
I got the honorary title just because I'm under the age of 40, right?
Yeah,
So therefore, no, but
Yeah.
no, I think that's a great point. And we've kind of been having that conversation with clients for a while now, looking at the kind of the ancillary winners or the derivative winners from AI, and if you look, not even last year, but maybe 2 years ago, it was heating and cooling companies, it was physical infrastructure. I think it's like Caterpillar, and there's a lot of overlap in your space and in kind of the broader AI tech trade. So no, I think it's not as crazy a concept as it seems when you first mention it. Dividends and AI, but there's a whole lot of overlap there. Um, I guess what I'm just thinking about, we field questions from clients every month and incorporate those, but obviously you're hearing from a very different subset. In some cases, it's a lot of institutional players, it's individual clients as well. What's on the mind of investors from your perspective that maybe we're not thinking of?
I think people are most concerned about is whether or not they're going to be able to preserve what they've made already. Um, that's what I hear a lot of. You know, am I going to lose all my money? Um, and the answer is, no, not if it's allocated properly, and you have the proper allocation, and you don't start to reach for the stars and buy things that don't make any sense. You're going to be okay. Um, you know, we're in a world right now where interest rates are not going to go back to zero. Inflation is probably going to be around that 2.5, 3%. That's not going to zero either. So in that kind of an environment, again, you're shifting towards more of a value mentality. Um, Companies with lower PEs, companies that have significant cash flow, and can withstand different types of market environments. So I think that landscape has finally shifted over from that growth to value, and it's going to be here for quite some time.
How do you think about the political side? I know it's always a touchy subject, but we tell clients it does appear from last week, and again, just 1 year ago, we were going through the tariff situation. How do you think about this? Do you think there's a Trump put? It seems to be, or a taco put in the market. And do you even think about that for your portfolio, or is it kind of like an evergreen strategy where you don't have to worry about politics?
Well, we have to operate with the hand that we're dealt with, right?
Right, right. Good point.
So,
Right.
um, and again, I feel like sometimes I'm a broken record, but the dividends cover a lot for investors, and it is kind of an evergreen strategy because it can help you get through these volatile times. Um, with that being said, yes, there could definitely be a Trump put here. There could be a Fed put here as well. So that's why it's very difficult in this type of an environment to say, you know what, I'm going to sit with 10% cash in my portfolio. That's a very, very tricky place to be. As long as I can find something that has a nice dividend yield and a low valuation, it makes sense to be invested. So those are chances we can take. We cannot manage the portfolio for every little wiggle that goes on in the market. It's not going to be good for investors. It's not going to be good for us. So,
Yeah,
you know,
I was reminding a client just a short time ago last year. If you stepped aside when everything kind of corrected itself with the tariff tantrums, it was like that one day it was 8.5% gain on the S&P 500. So imagine, yeah, you're right. If you kept your 10, 12% in cash before that, you're certainly going to underperform because you have a lot of money that's missing just that one big up day. We're certainly susceptible to that, as we saw to a lesser extent on March 31, right? We have these outside, and if you look at typically the quick corrections, whether it's COVID, they tend to be a V-shaped recovery anyway, right? Who would have thought? I mean, COVID, we think this is a correction, and we're, talking about the first quarter. I mean, it was like 34% correction in something like 23 days, and it was very much a V-shaped correction. So it's important not to step aside.
It's been interesting though. Sorry, go ahead.
No, I was going to say the only thing that we can really control is to buy good companies. So, I mean, so we have to focus on what we can control at this point.
I think that's great advice and a great reminder because you're certainly, despite the market action being more muted than maybe it feels like it's been over the last couple of weeks, I know we're certainly hearing from clients, and you always have a certain subset during any pullback that are a bit more nervous than say maybe the total client pool. But just with everything going on, you're starting to hear I think the most dangerous words in investing, that this time it's different and it feels scarier. And I think it's a good reminder that, as long as your portfolio is anchored and you're buying really well run, companies, strong balance sheets, good business lines, you're not immune from pain in that way, but you've got a really good shot long term of having a portfolio you're going to be very happy with.
Yeah, and I think we're in an interesting environment now because I think I love your answer, Catherine, about what or on the minds of clients because we hear that a lot too. It's phrased different ways, but like, yeah, we had all these years of gains, but if you give it back in like 2 weeks, you feel kind of dumb, right? You feel like you should have been more proactive, and it doesn't usually happen that way, right? So you have to look at things. You have to look at things over the long haul. But in this environment, I think most clients would take the trade-off. If you could be in a more conservative type of portfolio as far as downside exposure and get even close to the growth of the S&P. I think if we presented clients with, a hypothetical strategy, hey, we give you 85% of the upside with a lot less of the downside, most people would take that trade. The problem is, over the last several years, if you've not been in the hot sector, which is technology, you've drastically underperformed, except for people like you, and that's why you're in. I don't know what decile performance you're in, but it's got to be in the top decile, right? Because it's been hard to navigate that world if you're not overweight in technology. So.
Yeah, we've been able to, be in a capture ratio of where we're getting 92% of the upside and like 88% of the downside. So that's kind of helped us get through like a 2022 and at the same time perform in 2025, 2024, et cetera, and even, partially into this year.
Good. So thank you for coming on, and just so the clients that are watching this know, it's we didn't just pick Catherine out of a hat, her name out of a hat. We are Dan and I have done a deep dive over the last few months, and we've already talked to some of you about it. But we think Catherine's firm would be a great choice for our clients' portfolios for the dividend side or large cap value side, that part of the portfolio, and that's something we're in conversations with clients right now because I think you go through a little bit of a correction like this. It's not that big of a deal, but it is a good time to say, what is my growth versus value exposure? And for a lot of people, it's all growth or 75% growth. So I think this is an opportune time to reshuffle. And I would say the same thing for areas that we see a lot of our clients underexposed still in international. Same thing for small and mid cap stocks. One thing you can do on a proactive basis is just make sure you're properly allocated. So
Absolutely.
Dan, any final questions for Catherine?
No, just sincere gratitude and thanks. Been an excellent partner with our firm
Okay.
and our clients, and just overjoyed to be able to have you on to talk about what you're seeing in the markets.
Thank you,
Thanks for
Catherine.
having me.
Any
Thank you.
final words of wisdom, Catherine, for us?
Keep a long-term point of view.
That's a great one. That's always talk about an evergreen slogan, right? That's
Yes,
a
yes.
good one. No, so we appreciate your time, and we want to thank
Okay.
everybody for tuning in. Until next month, have a great. We're timestamped this. It's Good Friday. We're taping this on Good Friday. I think it'll be out probably. Our producer Joe would know probably on Monday. So everyone enjoy Easter weekend. But although you probably won't see the podcast till after Easter. But thank you for your time, Catherine. It's been a great podcast. Thank you, Dan.
Thanks, everyone. Take care.
Good day. Thanks.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors, LLC, an SEC-registered investment advisor. Concurrent Investment Partners, LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors, LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors, LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.